Happy Sunday, dividend growth stock investors. It is Colby the DGI Crab here, and we're about to go over each of the four tiers. What is that? Well, if you're new here, this is a unique dividend stock investing channel where I'm primarily focused with the age and time horizon of the investor, the most important metric that any growth stock, or especially dividend growth stock investor, should take into consideration. How long do you have in the market to allow those dividends to snowball? How quickly do you need the income right now? Those are the answers that you're ultimately going to have to ask for yourself. But what I've done is taken 60 individual stocks of the highest quality, split them into four separate categories or tiers based on the age and time horizon of the investor to make things a little bit easier for an investor of any age to narrow down their list of stocks that they ought to be paying attention to. I'm not a licensed professional, so you should always do your own due diligence before you make any investing decisions. I am just doing this for entertainment purposes and sharing my personal strategy with you. Maybe it'll give you some ideas. Now, my strategy is quite simple. I'm going to put half my money into age-appropriate ETFs, so I have automatic diversification no matter what I'm doing with my individual single stocks. Single stocks I hold forever unless they cut their dividend, and I'm looking for the ones that are yielding 30% or more above their 4-year average yield. That shows signs of undervaluation as a value investor. I have a list of top 10 favorite stocks that are part of the 60. Now, for those, I bend my own rules. If they're just 20% or above the 4-year average, sometimes maybe even not that much, I'll go ahead and add them because I just enjoy those 10 stocks and building the positions in those. And then I'm going to remain within my personal age tier unless there's a very undervalued stock in a different age tier yielding 50% or more above the 4-year average yield. And I will buy more ETFs if I don't like the options that I have available for myself during any given week. So that way I make sure that I continue to invest. Now, usually what I do here is when I jump into this spreadsheet where I've got the 60 stocks, I go right into tier 1. I'm going to just start here today a little bit different with the top 10 favorite stocks out of the group of 60. I've sorted everything here by the valuation tab where I am comparing that 4-year average dividend yield to the current day yield to see how big of a disparity there is between those two numbers. If we've hit the green, the stock is clearly in my buy zone. And because we've got this list of top 10 where my criteria is 20%, I'm seeing both Pepsi and Johnson & Johnson at values that I like buying them at this week. Pepsi has been down for a little bit right now. I've been adding to my position every single week with this wonderful 4.4% give or take yield. Great starting yield for Pepsi, really down right now. I think they will turn things around. Johnson & Johnson has just kind of hovered in the high 140s to the low 160s for quite a while now. It's a stock that has traded flat for several years, more or less, but the dividend does remain steady. It does continue to get increased year over year. I like Johnson & Johnson yielding at just shy of 3.5%. They typically grow that dividend between 4 on the low end to 7% on the high end, year in and year out. So I'm very happy to get the starting yield right there. So now, guys, we're going to go into just the age tiers here. So this is the group of stocks for tier 1, the 18 to 30-year-old investor, where we want to get not so much heavy focus on that starting yield. We really want to get the rapid year-over-year dividend growth. So think 1 to 2% yield, but 10 to 15% year-over-year dividend growth. UNH, Nike, Nordson are the three dogs in this tier, with Lowe's sneaking up and getting closer and closer to the buy zone. We got an underwhelming dividend increase from Lowe's recently, and then their stock price has actually slid a little bit. It's just right on the outside looking in for my buy zone. I probably want Lowe's right at about 210. Before I'm going to start adding to that position, but this dividend king is yielding just above 2.25%, with the 4-year average yield being 1.76%. We're certainly getting very close when it comes to Lowe's. Tier 2, age 31 to 41-year-old investors, where we're looking for a little bit higher starting yield in the low 2s to the high 3s. And we want to get high single-digit dividend growth rate, like 7 to 9% year over year. And that's the kind of thing that you're going to get with the stocks here on this list. We'll see here that Target and Hershey remain the undervalued stocks. Their 4-year average yield does continue to climb ever so slightly every single week. But right now, I'm still very comfortable buying both of these at the prices that they are at. NextEra Energy, McCormick, and American States Water, all stocks in that $70-ish range. They're all in the 70s. And they're all very close to my buy zone. And I really do. I just stick to these as closely as I can get. I want to keep my dollar cost average in NextEra Energy under $70. So I'm typically looking at around 71, 70.50 at the most before that gets into the buy zone. All 5 of these top 5 here are very, very solid, very stable. But I am going to hold the line here and wait to add the NextEra or the McCormick until they actually hit that 30%. McDonald's, one of my top 10 favorites. It's sneaking up there. It's not quite at that 20% undervalued mark just yet, but you better believe I'm keeping a very close eye on McDonald's, because if I can get this back down to about 270, I am definitely going to be excited to add to that McDonald's position. Tier 3, the 42 to 53-year-old investors, starting yield's going to get higher in this category still. We're looking, for the most part, low 3s up into the 5s for our starting yield. And we do want dividend growth rate right around 5%, that 4 to 7% that I mentioned that Johnson & Johnson does very consistently makes it a perfect stock for this age range. And that's kind of what we want to do with these stocks as a group. Johnson & Johnson is, in fact, in my buy zone as one of my top 10 favorites. Pepsi, the other top 10 favorite, is still the most undervalued stock in this group of investors here. It is open season on Pepsi buying regardless of your age. As far as I am concerned, I really like the value that I'm getting here. And Archer Daniels Midland, Hormel Foods, and Genuine Parts Company all continuing to remain pretty much undervalued. They've been all down for a little while now, especially ADM and Hormel. But until they stay down here for another 6 months or so, they're still going to look appealing to me, and I will add the yield in the high 3s in this age range if I can get it. I think this is very safe yield here. I'm also going to point out Procter & Gamble, another of my top 10 favorites, has gotten to the 10% higher than the 4-year average yield. You can currently get that yielding 2.66%. I want to get that a lot closer to 3% if I can. Procter & Gamble is about as safe of a place to park your money as any. You will get your passive income snowball moving along with Procter & Gamble, but again, I'd like my money to start buying me a yield at about 3% to start out if I can get it, because the growth rate, again, it's not going to blow your mind. 5-6%, usually somewhere in that range year over year. But like Johnson & Johnson, just remarkably steady, kind of dull, but you want to have a fair amount of stuff like that in your portfolio so you can sleep well at night and know that your retirement you've worked to build up is safe. For the Tier 4, 54 and older investors, so our blue chippers in this category remain generally overvalued. Nothing here jumps out at me as a strong buy. Realty Income looked a lot more appealing when it was yielding above 6%, but it's currently not right now, obviously. It's going to have to drop several dollars a share this week to start even approaching buy zone category. Most of these are actually yielding less than their 4-year average yield. So we'll start to see the 4-year average yield on some of the ones that have been up for a while, like Con Ed, like One Oak. Their 4-year average yield continues to gradually go down, which means that they can start looking a little bit more appealing at the current prices the longer that they stay here. And then as we hop over to the strategy tab, where we kind of break down how I would be allocating my money if I were in each of these individual tiers. If I'm in that first tier, my primary focus is just going to be to build up a strong foundation in the S&P 500 with a 25% allocation. I'm going to add some small cap ETF to my investments as well, because none of these stocks in that group of 60 are small caps. So I want to make sure that I do have some exposure in my younger years to building up that small cap position. I do like VIG, Vanguard's Dividend Appreciation Fund, as sort of a small foundational piece for this investor. Starting yield isn't going to be particularly high on VIG, but the dividend growth year over year should be very consistently solid. And then VYM is the only non-US stock investment that I make. I do 5% in VYM across the board, all age tiers. I'm going to get 1,500 or more individual stocks in that one ETF from Vanguard. They're high yielding stocks, so I can usually count on this one to give me about a 4-ish% starting yield. Really like BYM a lot. You should check that one out. Check out the video that I did on BYM in the ETFs playlist, where I compare it to some others. I think you'll see why I picked that one. For tier 2, it's the same 4 ETFs. I just switched the allocation around. I'm going to start hitting VIG and that dividend appreciation a lot harder from age 31 to 41. I'm going to keep adding to my S&P 500 and my small caps, just not as hard as I was at 30 and younger. For tier 3, I'm going to focus on ETFs like SCHD, VYM, DHS. I would probably have a little bit in each of those 3 buckets. You could also just pick your favorite one, do a 45% into just SCHD or just VYM, whichever one makes the most sense for you. And then for that group of tier 4 investors, you're going to have some stock focus here with SPYD, the 80 highest yielding stocks in the S&P 500. That could be about 15% of where you're going here. And then because there's nothing that I've invested up to this point except for stocks, I'm going to get some alternative investment vehicles going as well with consistently high yield that are pretty safe plays. So you have things like high yield bonds, preferred shares, MLPs, covered call ETFs, and of course some international. Since that tier 4 group still doesn't have anything undervalued in their group of 10, I would be doing an ETF double down in tier 4, just loading up those ETFs and the high yield that they provide. You're going to get lots of diversification and safe income by spreading it around over a lot of quality options like this. Now, I wouldn't double down on the international investment, so I'd probably throw a little 5% allocation toward Pepsi, yielding 4.4%. Maybe not quite as high of a starting yield as I want to get in tier 4, but that's roughly what SPYD is going to yield for the most part also. So I think Pepsi is just a nice individual play for that group. Now going back to our younger investors here, for the tier 1, for that additional 50%, or the 50% that's not ETF investment, I'm going to hit Pepsi harder than anything with a 20% allocation, even here in that 18 to 30-year-old category. And I'm also going to take advantage of getting a little Johnson & Johnson while it looks to be kind of cheap. The cheaper you get high quality blue chip stocks, the more potential you have for share price appreciation as well. So even something kind of dull like Johnson & Johnson can look a lot more like a growth play if you're buying it when it's in the 145, 150 range and then just hitting the pause button when it recovers to 165, 170. United Health, Nike, Nordson within my own category. I'm going to hit all of those, and I'll also reach up, grab a little Target out of tier 2 as well, because Target's still yielding 50% or higher above their 4-year average yield. For tier 2, the 31 to 41-year-olds, I'm going to hit Pepsi and JNJ first, come back around and address Target and Hershey in my own tier, and UNH and Nike down there in tier 1, comfortably above 50% more than their average yield. UNH still yielding twice the 4-year average, so it looks like a good buy for tier 2. And then for tier 3, a lot of choices here. Pepsi and J&J are within their own tier. They could finish that tier off by going ADM, Hormel, GPC. And then Target, UNH, and Nike are nice options even for that 42 to 53-year-old investor that wants a little bit higher starting yield. Target certainly is going to give them that, but even UNH and Nike in the high 2s is still pretty appealing to that group. You still want to get some stuff that'll grow. All right, guys, that is the video for the week. Email me any questions you have at dgicrab@yahoo.com. Let me know what you're buying. And until next time, let's keep investing, everybody.